A little bit about me. I've been doing exchanges in town since 2001. In my career, I've done over 20,000 exchanges. So if you have questions, I should be able to answer them for you. I also have a designation after my name of CES. You can see that. It stands for Certified Exchange Specialist. Well, what does that mean? It's like a CRS designation for a realtor. We have a trade organization called the FEA, the Federation of Exchange Accommodators. What we can do is once we've been in the industry for a number of years, we can test with our trade organization. If you pass the test, you get the designation. And to maintain it, we have to have CE credits, just like you guys have to get, but specifically on 1031. There's about 160 people in the country that have this designation. So I'm pretty proud of it. I'd get the tattoo if I wasn't afraid of needles. So it means that I stay up to date on what's happening on 1031s. Regularly, I go to DC with a group of us to lobby Congress to make sure they keep 1031s, because often over my career, they've tried getting rid of 1031. It happens all the time. So getting rid of it would actually hurt the economy, and we'll talk about that a little bit as we go forward. So we're going to go over all the details today on 1031. And like I said before we started the presentation, it's a really simple process from a real estate professional perspective. You don't have to work that hard. As a matter of fact, I think 1031s are great for you, because if you can find investors that want to do 1031s, that means they have to sell property, which you're going to get a transaction on. They also have to buy property. So hopefully you're going to get multiple transactions just from one client. And trends in 1031s, a majority of our clients sell one property and buy multiple. So you sell one, you buy two. So if you do that, that means 3 commissions. 3 transactions are going to close within a short period of time, which we'll discuss as we go through as well. All right. Did any of you come in with questions that you said, I got to get this question answered today? Or should I just start and then you can ask questions as they go through? Yeah, please.
Just how long does it take? Like, does it take additional time to closing?
It's a good question. No, it does not delay a closing. So as long as you let us know. This happens every once in a while. Your client, you're at closing, and let's say you're signing today, closing tomorrow. Yeah, signing? So you're at closing, client wants to do a 1031. You have to set it up with us prior to closing. What we have to do is the qualified intermediary must prepare documentation to be executed through the closing. If you don't set up a 1031 before the closing, they can't do an exchange. So every once in a while, I get this call. Hey, we're at closing, we're signing today, we're closing tomorrow. We just realized we want to do a 1031 exchange. Well, we can rush documents, but could it delay a little bit? At least the signing, because we got to get everything ready. So you always want to contact us, a couple of days before the closing, maybe a week, so we can talk to the client, make sure they understand the process, and get all the documents ready that have to be prepared per the 1031 code. So that's the only way it delays a closing. Other than that, no, it doesn't. It's just another piece of the puzzle. So no delay. All right, so let me go ahead and jump in. I'm going to throw some numbers out here, and I'll explain the reasons behind it in a second. It's important in 1031 to understand the number of rental properties in given areas. So where are people exchanging properties from to come to Vegas? We deal with a lot of Hawaiians. We deal with a lot of Californians. California. Everybody wants out of California. And it's even worse, I'll be honest with you, it's been worse over the last 3 weeks with all the wildfires. They're not going to rebuild. Not everybody. Some people are going to say, I'm done. We've already seen it. We're already hearing news stories about Californians coming here saying, I just can't do it anymore. Whether it's because of wildfires or taxes or political reasons, Californians have been leaving California for a while. They've been coming to Nevada, they've been going to Texas, they've been going to Florida, they've been going to the Northwest because they're leaving California. The population in California has been negative for years, keeps on going down. So one of the places they're coming is Vegas. Well, one of the reasons, lower prices on homes, and no taxes. Those are just, well, I said one of the reasons, there's two. There are other reasons, but those are two of the big ones. So they're moving their properties here and they're moving their investments with them. So by doing that, they're gonna make more money. Because if I have a rental house in California, if I move here, the first thing I don't pay anymore is state tax. So on that rental income, I'm gonna make more money. So Nevada's a good place to be. And then also, I just dealt with a client, sold a standard 3-bedroom, 2-bath house in Irvine, California. She had owned it for a while, like 20 years. She owned it free and clear. She sold it for $935,000. She was only renting it for $2,800 because that's all she could get. She sold that house, did a 1031 exchange, came here and bought 2 houses with it. She is now making over $4,000 a month on her 2 rentals. But on that one rental she sold, she was getting $28,000. And all she did was take the cash that she netted from the sale and used all that cash to buy 2 properties. So she didn't put any more money into it. She just literally moved the cash into 2 properties, and she now got about a 50% rental increase by just moving to Nevada. And that doesn't even account for the fact that she doesn't have to pay tax on those rental increases anymore. All by moving to Nevada. So, or I should rephrase, all by moving out of California. That's what we're seeing a lot. People are saying, I can get more bang for my buck here than there. So, in Clark County, 45% of our single-family residences here are rentals. So, of all the single family, almost half are rentals. In Hawaii, it's 30%. Hawaii County, excuse me, 30%. Honolulu County, 42. LA County, 54. Maui County, 39.2. That's a lot of rentals. Yeah.
I'm hearing a lot about like corporations buying properties out here. Is that a reason why it's so high out here?
That's part of it, yeah. The thing is, we don't know exactly what that percentage of it is corporate owned. That's not declared. We get this information from the IRS. If there's a public website you can go to find out these numbers. So it doesn't say who owns what. It just says by certain areas what the percentages are. So as you can see, I look at where are we seeing a lot of our clients coming from. And like I said, Hawaii and California or something. Other than the ones doing exchanges here, that's where a lot of our incoming properties are from. Now, when we just start talking about locally, this is the percentage of renter-occupied properties locally. And I also have this information on the back of that flyer I gave you too. So it's the same map. So you can see, like Boulder City, 25% of houses in Boulder City are rentals. Boulder City, little sleepy town. You wouldn't think 1 out of 4 homes are rentals there. There are. Start going through Paradise Township, right in the center. That's where UNLV is at 61%. That's a huge number. And the reason being is that anytime you see a university, numbers spike. Do you want to live across the street from UNLV? No. But it's a great place to have a rental because you're always going to have built-in renters because of all the students going there. You know, Spring Valley is pretty high, 54%. So we've got a lot of rentals in town. That's why 1031s are important here in Las Vegas, because you eventually, if you haven't, you're going to deal with investors. And if you don't understand the 1031 exchange, they might not want to use you for that transaction because they say, well, they don't know what a 1031 is, I better find somebody that has experience. So 1031s are important in the real estate market. And it's because, like I said, all these rentals out there. And like I mentioned on that previous slide, in total, Clark County is 45.7%. Like I said, that just broke it down by certain areas. So, what is 1031? Like I said, a 1031 is specifically a way to defer taxes through the 1031 process, but it has to be on properties held for investment purposes. So I'm not going to read the whole code to you, it's 52 pages, but if we just look at the summary, basically what it says is that no gain or loss shall be recognized on the exchange of real property held for productive use in a trade or business or foreign investment if such property is exchanged solely for property of like kind, which is to be held either for productive use in a trade or business or for investment. What does that mean? Sell an investment property, buy an investment property, you can do a 1031 exchange. Simple as that. Now the reason it says effective January 1, 2018, this code was written back in 1921. But in 2018, let me rephrase, in 2017, through the Tax Cuts and Jobs Act, that was when President Trump was president's first term, he had a tax bill that came out. I'll give you a quick story about that. November 9th, 2017, I'm doing a class with about 50 realtors up in Incline Village. So the lake is literally right behind me in some windows. I'm talking to a group of 50 realtors, and as I'm speaking, the tax bill was released. Tuesday, November 9th. And as I was speaking, it came out, and it's going to be voted on Friday. So they released the tax bill, and in only 3 days, it's going to be voted on. So we didn't have a lot of time. And when I got done with my presentation, as I'm looking at my cell phone, I got blown up for the last hour and a half as I'm talking, because the tax bill called for the complete elimination of 1031 exchange. Remove it from the tax code. So literally, I was wearing one suit. I had a suit on at the time. I had a change of clothes in my suitcase. Instead of coming back home, I flew to DC, and we lobbied for 3 days to save 1031 exchanges. Me and about 30 other 1031 professionals from around the U.S. because we're part of a committee to lobby, and we go to DC pretty regularly to maintain 1031. Well, we were able to keep 1031, but we lost part of 1031. Through the tax bill, they added one word to the 1031 code. It's that word underlined, says real. Prior to the bill being passed in 2017, you used to be able to do what are called personal property exchanges. There were real property exchanges and personal property. So, for example, if I had a client selling a bar, which I did have a client, sold a bar right on the corner of Sahara and Buffalo. Now it's like the 4 Sevens bar. No, now it's Bourbon Street. They changed it. But years ago, about 10 years ago, my client owned it, and he owned the building, the land, and the business. He was selling it, and he said, I want to move back to Chicago, and I want to buy a new farm. But he wanted to do an exchange on the land and the building, the real property asset, but he also wanted to do an exchange on the personal property assets inside, which were like the tables, the chairs, the kitchen equipment, the POS, the signage, everything in that building. So he was able to do 2 exchanges, one for the real property, one for the personal property. So when he sold it, he had no tax. As long as he went and bought new real property and new personal property to occupy that business. And then what he did was he went back to Chicago, he bought an existing bar that had kitchen equipment and tables and chairs. So he bought it all, so he deferred his taxes on the real property and the personal property sale from here. But when this bill was passed, we lost the personal property exchange. So you can't do personal property exchanges anymore. And we used to do a lot of them. Real property are much more common, but personal property exchanges were pretty regular. I've done cattle exchanges. I've done aircraft exchanges. I've done exchanges on FCC licenses. I had a TV station in San Diego, sold a FCC affiliation to CBS. They sold their CBS affiliation and they bought an affiliation for NBC. Well, there was value in that, so they didn't want to pay the tax. The tax would be, if you bought that affiliation for $1 million, but you bought it 10 years ago. Well, now when you sell it, maybe the affiliation is worth $2 million. So then you defer your tax on the profit. So they were able to do a 1031 exchange and not pay that tax. And so the same thing can happen on any other type of personal property. But like I said, now that no longer exists. So now we just talk about real property exchanges. That part of the exchange was eliminated through the Tax Cuts and Jobs Act of 2017. We weren't able to save that. But we saved the real property, which is what you're going to be dealing with 99 times out of 100.
Do you see anything happening this year with
Yeah, maybe. Do I see anything possibly happening with 1031s this year? We are a little concerned. The Tax Cuts and Jobs Act had a lot of tax changes. We can't even go into all of them that happened, but all of those tax cuts expire this year. So you're gonna hear all year that the Tax Cuts and Jobs Act has to be renewed for 2025, because they all expire at the end of the year. If they don't get, if nothing gets passed, the income tax rate, it was dropped overall, it was dropped a point or two for every tax bracket, it would go back up. Like, the highest tax bracket dropped to 37. If it doesn't, if this doesn't get renewed, it goes back up to 39.6. And you'll see that across the board, the graduated schedule, that every bracket goes up a point or two, shall we say. But a point or two can be a lot of money. So to renew those tax cuts, the estimate is that it's gonna cost $5 trillion a year. If they're gonna renew those cuts, they have to find the money someplace. So what 1031 becomes is a pay for. We can eliminate 1031 to pay for these other cuts that we wanna keep. So, yeah, we are expecting as an industry that we're gonna be in DC regularly this year to make sure they don't mess with us. Every real estate organization you can think of supports 1031 exchange. NAR has always had our back. They're always there lobbying up with us when we need them. Every commercial real estate organization, CCIM, ICSC, SIOR, everyone, they all know the value of 1031. Because if you eliminate 1031 exchanges, some people won't sell. Because people are incentivized to sell because they know they can do a 1031. If I sell, I can defer my taxes by doing 1031 exchange, so I'll sell, I'll buy a new property, I don't have to pay my tax. So that's a benefit. I can move properties, and I don't have to pay anything. But if they say eliminate 1031, and now you have to pay, some people will say, I'll hold off a while. I need to get a little more profit to be able to pay my tax. So, do we know what that number is? No, we have no clue of how many people will say, oh, I'm gonna hold off, but somebody's going to. Some people will hold off. And what does that mean? That means less transactions for real estate professionals. Well, gosh, last year was already a pretty low year. Do you wanna see less transactions in 2025 or 2026, or do you wanna see more? 1031 encourages transactions. So, we make sure that it's still there. And that's why NAR is totally behind it. That's why they know, matter of fact, they've helped us fund studies with Ernst & Young showing the benefit of 1031 to the economy. So, yeah, personally, I'll be in DC. It's already scheduled in February. I'll be back there in April, and then I'm sure there'll be other times. And why are we going back? To lobby, to speak with congressional representatives to make sure they understand the benefit of 1031. All right. What is like kind in 1031? Anything. Any real property qualifies for 1031 exchange, as long as it's held for investment purposes. So you could sell a single family house, or you can buy ag land. You can sell an apartment building for retail, office, or warehouse, a fourplex for a tenant common interest in an office building. It doesn't matter. That's another great thing about 1031. You can change the type of investment. I just had a client sell a property in Starbucks in Mesa, Arizona. And he came up here and he bought 4 houses with the money. He wanted to go from commercial to residential because his cap rate wasn't great on the commercial. He said, I can buy property here and I'll have more rental income. So he sold a Starbucks and he bought houses here. Yeah, please.
How long does a property have to be a rental property before it can qualify? For example, if someone has a second home and then they turn it into a rental for 1 year, will that then qualify for a 1031 exchange?
That's a great question. So how long does that have to be rented? We don't know. The code doesn't say, and no other rulings outside say how long it has to be rented. All the code says, if I just jump back a little second, it just says property must be held for productive use in a trade or business or for investment. It's vague. So I always say talk to your tax person. What do we hear? What's common? tax people will say a year to 2 years. Is it required? Not per the code. So personally, I'll make it a little simple. I go buy a house today as a rental. I put tenants in there. And let's just say in 3 months, the tenant says to me, Carmen, I wanna buy this house and I wanna buy it at 25% over what you bought it for 3 months ago. I'm selling it and I'm doing a 1031 exchange. Because my intent when I bought it was to hold it for investment purposes. I put a tenant in there and they just love the house and now they wanna buy it from me. Did I do anything wrong? It's an investment. Personally, I would do an exchange every time. Would my tax person love it? I don't know. But I would tell my tax person, again, I've been doing this for a long time. I would tell my tax person, show me in the code where it says I can't. And if not, I'm doing it. And your tax person cannot show you because the code doesn't give you any time frame. So a year to 2 is the standard, give you the warm fuzzies. But it doesn't say.
Gotcha.
So
Sounds to me like it would be smart, even if you had your own personal residence, and then, okay, I'm gonna turn this into a rental for a year, and then I'll sell it and defer the taxes.
yeah, the problem with a personal residence, like your primary.
Yeah.
First off, the primary, you already get the 500,000 tax-free if you're married. If you live in a primary residence 2 out of 5 years, you get 250,000 tax-free if you're single, $500,000 if you're married. So you already have that built in. And then secondly, if you sell your primary residence, well, you're gonna sell your primary. If you convert it to an investment, put a tenant in there for, let's say, a year. You sell it, you do a 1031. You have to buy another
Oh,
investment.
that's true.
It's investment for investment.
Mhm.
So now you lost a place to live.
I gotcha.
So
Makes sense.
I wouldn't want to lose that. You know, I need my house. So, you know, there's things like that. That's why you give us a call when things like that come up. When you have those ideas, we say, all right, here's the pros and cons. So. Now, property does have to be in the U.S., so you can't sell the Washington Monument by the Eiffel Tower. Yeah, sorry about that. You have to stay in the U.S. for 1031 because the IRS wants to track you. You're deferring taxes. They're not going to let you sell property here or buy something in France. Because then when you sell there, they'll never know. And they can't track those tax dollars. So it has to all be in the U.S. Now, there are specific financial requirements you have to meet when you do a 1031 exchange. There's 2. To defer all your taxes, an exchanger must do 2 things. First off, you must reinvest all the proceeds from your sale as down payment on what you buy. That's number 1. Spend all the cash. Number 2, if you have debt in the property you're selling, you've got to get new debt in the property you're buying of equal or greater amount. That might not make sense. Let me give you a couple examples, and it will make sense. So, the reason IRS created 1031 was they wanted to keep the real estate market growing. So, they don't want retraction, they want expansion, because that's good for the economy, right? So, they say that's why they put these values in, and that'll make more sense as I go through. So in this next example, we're gonna sell the same piece of property. We're gonna sell a property for $1 million. We're gonna have a $400,000 loan payoff at the closing, and we're gonna net $550,000. So the first thing you're gonna say is, Carmen, your math stinks, because if you sell for $1 million, you have a $400,000 payoff, you're gonna net $600,000. No, you're not. You're gonna have commissions and title and escrow fees. And so I estimated $50,000, which is actually pretty low. But let's just pretend you paid $50,000 in costs. So you net $550,000. So for the 1031 exchange, following those rules I just gave you on the previous slide, the first one was spend all the cash. You have to use all $550,000 as down payment on what you buy. That's number 1. Spend all the cash. Number 2, it said if you have debt on the property you're selling, you must reacquire debt the property you're buying of equal or greater amount. So we had a $400,000 loan payoff on the property we sold. So we've got to get a loan on the new property for a minimum $400,000. If we do that, this is the minimum requirement. Taxpayer has no boot, no taxable liability. If you ever hear the word boot, it means somebody owes tax. Literally, you can replace the word boot with taxable liability. So in this case, we have no boot, no taxable liability, because they spent the cash, they reacquire debt equal to the debt that was paid off. This example, they defer all their taxes. Now, you don't just have to buy one property. Could I leverage and buy two? Sure. 3? Sure. Doesn't matter. Just as long as at the end of the day, did you spend all the cash? Did you reacquire the debt? If you do that, you defer your taxes in 1031. But that's not the common way. Most people are gonna buy more. Normally they do. So can I go buy a property for $1.2 million? Sure. You only have $550 in your 1031 exchange, so the $550 goes down payment, you're gonna get a bigger loan. Still, no boot, no taxable liability. Now, what happens with that $550? Where did it come from? Well, it came from your sale. Now, before that sale ever closed, you had to set up a 1031 exchange with a qualified intermediary like us, Security First. What do? We work with the title company, we get everything ready for the closing. Now, when the sale closes, the client's netting $550, right? They don't get the money. They're not allowed to touch it. If they touch it, it's taxable. So there are 2 roles the qualified intermediary fills. 1, documentation. We prepare documentation in coordination with the 1031 so that if the IRS ever looks, we can show them that everything was done right. So we document the transaction. That's number 1. Number 2, we hold the money. The taxpayer can't touch the money. So when the sale closes, they don't wire the money to the seller, they wire the money to us. And what do we do with the money? What we're gonna do, we open up segregated accounts for every client. So if we have 1,000 clients nationally right now, we've got 1,000 accounts at the bank. 1 for each client with their name and their tax ID on that account. So they get the FDIC insurance, they get the interest, it's just like it's their account. It is. It's just that we manage it. The client doesn't have access, but it's their account. We've never commingled funds. There are some QIs out there that commingle. And what that means is they just open up one account at the bank. So let's just say I have my own exchange company, Carmen's Exchange Company. What I do is I open up one account at the bank under Carmen's Exchange Company, and all of you do an exchange with me, I stick all your money in that one account. So everything's commingled. Excuse me. That doesn't give you any benefit. You don't get any protection because you don't earn the FDIC because you don't have an account. Secondly, you don't earn the interest because whose name is on the account? Carmen's Exchange Company. So you don't get any of that. You don't have the security, you don't have any benefit. It's not the best way to hold money. It's commingling, it should be a 4-letter word. It's a bad transaction. So what we do, and most good QIs will do this, the segregated account. Everybody gets their own account, that way everything is accountable.
You never really, you're just avoiding taxes then, because you still have to pay for them at the end, right? Unless you die or.
So when is the end? So let's say you do this exchange. You sell this property, you go buy this property. In 5 years, that property you bought for $1.2 million is now worth $2 million.
But if you sell it, you have to pay taxes on that.
No, you don't. What can you do? Do another exchange.
So,
You can keep on exchanging. So that's one way to never pay. I have clients that call me all the time, every couple of years saying, all right,
but then,
go ahead.
but then at that time, that you never see that money because you have to use that money to pay for the next property. So in
So-
reality, nothing's ever yours.
Well, it's yours.
Well, it's my debt. But
Well, it's your property too. What if you own the property free and clear? There's no debt. So
if I sell it, I'm gonna have to pay taxes on that.
if
On
you
those two
sell
months.
and cash out,
Yeah.
then yes, there will be a tax liability. Let me give you a different example. I just wrapped this one up. I have a client I've been working with for like 20 years. Her and her husband have leveraged. They started with me back in 2003. They've gone from 1 property to 5 properties here locally. On these 5 properties, they now are renting them out. They're getting about $10,000 a month rental income. In the last 2 years, her husband passed away. Sorry. In the last 2 years, her husband passed away. So now it's just the wife. She's 82 years old. She has these 5 rental properties. She told me recently, with the rental properties and the pension, the 401k and Social Security and all those other things she has, she says she's getting roughly $16,000 a month in income. I'll retire right now if I can get 16 grand a month. I can play a lot of golf on that. So she said, I'm never gonna sell. Because if I sell a property, what am I gonna have to do? Pay the tax. So I'm gonna just keep this income forever, but then when I die, the properties will get passed to my heirs, and she has structured it with her tax professional so that the heirs get what's called a stepped up basis, meaning the tax will die with her. The kids won't be taxed, and what happens on stepped up basis, I'll give you just a basic example. If I buy a property today, a piece of dirt, for $100,000, let's pretend in 2 years it's worth $200,000. If I sell it in 2 years for $200,000, I pay tax on my profit, $100,000. Instead, in 2 years, I pass away. As long as it's structured properly, my heirs will get a stepped up basis. So let's just pretend I have 1 kid. I have 2 actually, but 1 won't exist. So let's just say my son inherits the property. He will inherit the property at the value of the property at the time of the inheritance. What's the property worth the day I died? Well, it's worth $200,000. If my heir sells the property a month or 2 later for what it's worth for $200,000, they have no profit. They inherited it at $200,000. They sold it for $200,000. No profit, no tax. Even though I had $100,000 profit in this property, but that died with me by the heir getting a stepped up basis. The same thing happens with 1031. All those taxes that you've been deferring for maybe 20 or 30 years will die with you upon your death. So you have to structure it with your tax professional to make sure you get a stepped up basis. But if you do, it's not hard, but if you do, your heirs will never pay. So it's a way to get out and never pay the tax.
I have 2 more questions, I'm sorry. Okay, so let's say, I buy and I'm married, I die, it's gonna, those taxes that I owe, it's gonna go to my wife, right? And if she dies, there's no tax.
She will get a partial stepped up basis.
Okay.
She'll get a stepped up basis on your half of the property. But then yeah, when she dies, goes to the kids, all gone.
Okay, and then the second question is, what if the 1031 is abolished while I have all those events?
Yeah, if they happen to get rid of it at some point, it doesn't change anything in the past. So you've done exchanges for 20 years. You're fine.
Okay,
It's just that you can't do anymore.
so your grandfather did basically, okay.
Exactly.
So I got a question. So does that apply just to federal, or say if they moved it originally from California out here, how would that work? Would it be the same way on California state?
We're gonna go over to all the taxes deferred, but
Or
I'll
Hawaii tax?
tell you right now, yes, you defer state tax as well.
I mean, when they eventually pass and goes to their
Oh.
kids.
All gone.
Okay.
Everything's eliminated. Stepped up basis eliminates everything.
Even state taxes, like California,
Yep.
Hawaii,
And California's the worst. California's the highest state tax in the country.
like 14%.
13.3 is the highest rate there. And they've got a bill in their legislature they're talking about 16.8.
That's crazy.
That's another reason people are leaving. Yeah.
It's New York too, right? New York's
11,
taxes.
New York's 11.1, I think. But yeah, so New York, New Jersey, California are the 3 highest in the country.
Oh, okay.
And yeah, Nevada, what's our state tax?
Nothing.
Love it. 0.
I have one more question.
Please.
So, say somebody sells in California,
Mhm.
are you operated in California or Hawaii too, or just in Nevada?
Oh, we can do exchanges because it's federal tax code. We can do exchanges in all 50 states.
So if somebody sells in California, doesn't use you, they use somebody else, does that intermediary have to hold the money until somebody, and disperse it until somebody buys?
Until they buy a new property, yeah.
Are they the person who has to hold it from sale to purchase?
Yep.
Okay.
Has to be a qualified intermediary like us. And yeah, they receive the money from the sale, and then when you buy the new property, they're gonna fund the purchase. So,
How do they do that?
we'll talk about that, so, yeah. It's really easy, we just It really is. There was this example, you buy bigger, there's no liability. So every once in a while, a client says, well, I don't want to exchange all my money. I'm gonna get net 550 from the sale, but I only want to exchange 400. Can I take 150 at the closing? Can I take 150 out? And yeah, you can, but you're gonna pay tax on it. Whatever money you remove from the exchange is taxable. You pay state tax, federal tax, everything. So that's called cash boot, because now it's a cash tax liability, because you took cash out. Last example, and this one gets confusing. A lot of people think if I sell a property where I net 550, they think all I have to do is go buy property for 550. You don't, no. You've got to reacquire that debt that we talked about. And if you don't, so if you don't get a loan for 400,000 at least, you're going to pay tax on that 400,000. This is called mortgage boot because you didn't replace the mortgage. So remember when you're dealing with somebody, basically look at the settlement statement. And you say, all right, when they sold, they netted 550 and they had a loan of 400. So on the new property, at minimum, we have to use all 550, we have to get a new loan of 400. That's how we defer all of our taxes. Those are the financials in a 1031. That kind of makes sense? Right now it's gonna make a little sense. When you do one, it'll just, oh, I got it now. Okay. There are time frames for a 1031 you have to worry about. The 45-day identification period and the 180-day exchange period. Now I'm going to show this to you on a timeline. Day 0 of an exchange is the day of closing. So the day of transfer of ownership from the seller to buyer. That's day 0 of a 1031. So day 0 when I'm doing this. That's day 0 of a 1031. The day after the closing is day 1. Clients doing 1031 exchanges have 45 calendar days after the closing of their sale to identify, to tell us as the qualified intermediary exactly what they're going to buy. You can't just say, I'm going to buy a house in Las Vegas. No. I need property, address, city, state. You have to know exactly what you're buying in the 45 days. And you have to close it within 180 days. 180-day closing, that's easy. But 45 days, that's the hardest part. Because that gives you a month and a half after closing, basically, to find what you want. And the thing is, what you have to do is the client has to use what's called this identification form. So after your sale closes, we give a client a form to complete. So identifying property with us is easy. They just write down the property address, and you can't see that. They just write down the property address on the form and send it to us. Well, that's easy. But here's the catch. Within this 45 days, you're allowed to identify up to 3, and you can't change it after the 45 days. So let's say the client writes down this form, 1000 Main Street, 2000 Main Street, 3000 Main Street, Las Vegas, Nevada. Once the 45 days is over, that's all we can help them purchase. Nothing else. Well, what if you can't get them under contract? You're out of luck. Can't buy anything else. So within that 45 days, what you want to do as the real estate professional is get the property under contract and do some due diligence on that property so you know it's going to work. Because again, once this 45 days is over, this is it. They can buy nothing else. And that's not our rule, that's the IRS rule. So every QI you would deal with, we all have the same rules because we all work off the IRS rules. So finding that property is the hardest part of the 1031. So you really want to dig in and find it as soon as you can within that 45-day window. Does that kind of make sense? Kind of. So don't waste time. If it were me, my clients got their property in escrow, the one they're selling, right? When the due diligence period passes, so now we're down to the last 14 days, 10 days before closing, I'd start looking. We start hitting the ground. We're out there looking at properties. Let's get one under contract, even before the sale closes. That's fine. But let's find our property, because that's kind of free time, because the sale hasn't closed yet. So the time frame doesn't, oh, my apologies. The time frame doesn't start until the closing. So if you're looking for property before closing, that's all free time. But once that sale closes, now the time starts ticking. So hit the ground running. Do not waste any time. Don't let them tell you, oh, well, you know, I can't go look at anything this weekend or this week. They're just wasting their own time.
So I guess my question is, so on the sale agreement, if they sell here, and they buy something else, on like, who they're using for like escrow, we put your name on there?
No, I'm not the escrow company.
Okay.
So you use whatever escrow company you want. We work with every escrow company in any state. Like I said, we work nationally, so it doesn't matter. So what you do, just disclose in the purchase agreement that the client's doing a 1031. If you're using the LDR contract, there's already a disclosure. Paragraph 25 says seller or buyer reserves the right to do a 1031 exchange. Other party will cooperate in signing documents or something like that. It's already there. So all you do, so what's the process? The process is get the sale of property under contract, open escrow, and then call us. And then we work with that title company to get everything ready for the 1031. Now, sale closes, money comes to us, time frame start ticking. Now you have the 45 days to identify and the 180 to close.
So where do we put your name anywhere in the purchase?
Nope, you don't need to at all.
Or just say nothing? No?
It's kind of like, think of us like an appraiser. You don't have to, or an inspector. You don't have to put an inspector's name or an appraiser's name in a contract, but you can use one, right? Same thing with the 1031. So you can use any 1031 company you want. You don't have to disclose it because the other party doesn't care. Think about this. You're selling a piece of property, okay, for a client. Forget 1031. And you find out the buyer is doing a 1031 exchange and we're holding their money. Do you care? You don't, I mean, I would say you don't. I mean, do you care which 1031 company it is? No. You just care that the money gets in, right? Whether they're buying the property cash. So if they come out of pocket with cash, you're happy. If the money comes from a 1031 company, you're happy. You don't care as the seller. Just get the money into escrow at the closing. So in a way, you don't care. All you care is about the money is deposited, right? If you're selling, yeah. So it's not relevant to the other party. Again, we need to know, and the title company needs to know, because they're going to need to know I'm calling them. You know, so again, if you're going to sell a property, client wants to do a 1031, you just tell me, all right, we're using XYZ title company, reach out. And that's normally the process. Normally what happens is, like I said, you get the property under contract, you open escrow at the title company, and you call me. Say, hey Carmen, we have a transaction we just opened up with Mary Smith at XYZ Title Company. Give them a call and get it set up. I call Mary, and we coordinate everything for the 1031. Sale closes, money comes to us, and the same thing happens on the purchase. You get a property under contract that you want to buy. You open up an escrow with Mary Smith at XYZ Title Company. And now you call me again, you say, Carmen, we got a purchase ready to go. Mary Smith, XYZ Title Company. We call Mary and we coordinate everything. When we get to the closing, we wire the money in, deal closes. It's literally as simple as that. I know it sounds too easy. It is that easy. The paperwork is easy. We handle all that for the client. Yes, they have to sign. That's easy. The hardest part about this whole thing is finding the property within the 45 days. You can do that, and that's your job. That's not me. I am not a licensed real estate professional. You got to do that. Everything else, we'll take care of. Yes, there can be complicated to it, but it's pushing paper. It's transactional stuff, and my team and I will get that handled for you. It's easy. Kind of make sense? Okay. So yeah, the time frames. 45 days to identify the property, 180 days to close. Client sends in this form within the 45 days telling us what they're going to identify. Simple. Now, why am I doing all this? Why are you doing all this? Because you don't want to pay taxes. What taxes are deferred by doing 1031? There's 4. federal capital gain, state capital gain, the 3.8% net investment income tax, and a recapture depreciation. Sounds like a lot. But what are they? One, federal capital gain. Federal capital gain is either short-term or long-term. If you own the property for less than a year, it's a short-term gain. So let's just say you sold the property and you made $100,000 profit, okay? If you own that property for less than a year, that $100,000, if you didn't do an exchange, will be taxed as income. So let's say you made $200,000 this year at your job. But if you sold this property that you only owned for 6 months, that $100,000 profit becomes income. Now you made $300,000. So what's that going to do to your tax bracket? It's going to bump you up. If it's a long-term gain, meaning you've owned it for a year and a day or longer, you pay 15%. If you're single, you make under $533,000 a year, or if you're married, you make under $600,000. So if you didn't do an exchange, you own it for longer than a year, you pay 15% on that $100,000, so $15,000 in tax. If you're over those thresholds, you would pay 20%. So that's the first tax you defer by doing 1031, federal capital gain. So at minimum, you're going to pay 15%, so $15,000 on every
How long
$100,000.
has it been like that?
Forever. It's been a long time. Now these numbers, the 533 and 600, those change every year.
Okay.
Because what happens is as inflation grows, those numbers get indexed. So it does go up every year. But that's actually for 2025. I just updated this slide a couple weeks ago. So that's number one, federal capital gain. The second tax you defer is the state capital gain. And we already discussed this. We don't have one, but 41 other states do. California we talked about, up to 13.3%. It's pretty high. By doing a 1031, you also defer the state tax. So that $100,000, if you owe 13% in California, that's $13,000. You don't pay it by doing 1031. You get to defer it. So just starting with those two taxes, what does deferral mean? Like I said, we push it down the road like we talked about until you sell and then don't do an exchange, or you die and then you get a stepped up basis, you never pay it. But the 1031, think of it this way. Think of it like an interest-free loan from the federal government. They're saying if you follow the rules of 1031, you don't pay. You get to keep those tax dollars you were supposed to pay the federal government and the state. You get to use that money to go buy more property. So instead of paying $15,000 to the government, $10,000 to California, that's $25,000. I get to keep it, and I get to use that money to go buy more property. So I have more money to buy property. I get to use it for free, as long as I follow the rules of 1031. I don't pay it, I get to keep it. I get to make money on this money I was supposed to pay in taxes. That's what a 1031 allows. Allows you to keep your money and not have to pay tax on it. Sound like a pretty good deal? It really is. Those are just two taxes though. The third tax you get to defer is called recapture depreciation. What's that? It's not a tax on your profit. When you own a rental property, you really own two things. You own the land and you own the building on the land. So if you just own dirt, there's no buildings. But if you own a rental house, that house on the property is actually worth less every year, because that house is getting older. Cracks in the walls and the foundation. You know, a 50-year-old house is not worth the same amount. Let's say, the exact same 2,000 square foot house, okay? Built 50 years ago and built 5 years ago. The 5-year-old house is worth a lot more, right? Because the 50-year-old house is just older. Houses don't last forever. So as you own a building, you depreciate it. You take a write-off on the building. If I bought a $300,000 house today, I would probably take a $5,000 depreciation on it every year, a deduction, because that's how much I would get to write off for it getting older. So every year I would take a $5,000 write-off. Great. That's a deduction every year, $5,000. Let's pretend I own that house for 10 years. I've taken a $5,000 write-off every year for 10 years. That's $50,000, right? When I sell it, if I don't do a 1031 exchange, the IRS says you have to pay back what's called recapture of depreciation, which is 25%. So if I depreciated it $50,000, when I sell it, 25% of that, that's $12,500 I have to pay the IRS. Unless I do a 1031 exchange. Then I get to defer it, just like everything else. Now you might just say, well, I just won't depreciate a property, and then I don't have to worry about it. IRS doesn't let you do that. They say if you have an investment property, you must depreciate it. So if you own a rental house, you're taking this write-off every year, which is great while you own it, but then you get the hit when you sell it, unless you do a 1031 exchange.
I have a question. So say somebody had a rental in California and it was burned to the ground from fires.
Okay.
And they decided they want to sell it and move here.
Mhm.
Would that have any impact on this 1031 or the values at all?
It can. So,
Sorry, it's a little complicated. but
yeah, it is a
might
little
be real.
The question that you didn't hear was talking about the wildfires. What if someone has a rental house in California, it was burnt down through the wildfires? They depreciated over the years. Let's say they owned it for 10 years. That recapture depreciation is still due. And they could still have a profit on the property. Especially California properties, especially coast properties. And again, just my experience, but those properties on the coast in Palisades and Malibu and Newport, and there's no fire in Newport, I'm just throwing that out there. I see those are generational properties many times. They passed from grandparents to parents to the kids, and so they've owned it for a long time. And they have such a low basis in the property. And so if I had a property, let's say I bought a property in Palisades where there's one of the fires, and let's say I bought it 20 years ago. I bought it 20 years ago for $1 million, and today it's worth $3 million, but it was burned down. So my insurance claim will pay me, you know, what's the value of my loss. So let's say they say it's not even worth $3 million, even though you and I know I could have sold it for $3 million before the fire. Let's say my payoff is $2.5 million. What the IRS says is, you bought the property for $1 million. You just got a $2.5 million payoff. You have a profit of $1.5 million.
So it's the insurance proceeds over the,
Yeah, because that's supposed to be for rebuild, right?
right,
If you just take that money and run, you're going to pay tax on $1.5 million.
okay. So say they get the insurance money for that, they just want to sell. Do they have to use all that insurance money for a new 1031 then?
They would have to use all of it. Anything they don't use is going to be taxable.
Okay.
Yeah. If they only use $2 million of the $2.5 million, then $500,000 they're going to end up paying tax on. Federal, state, so you know numbers can be pretty high. So yeah, I mean, it gets a little complicated when we start talking about those insurance payouts and stuff. But yeah, the IRS looks at that as profit, because basically you bought it for $1 million and you just got paid off $2.5 million. Whether you got paid off because you sold it, whether you got paid off because an insurance payoff, you received that amount of money. So, yeah, and technically in that situation, in a disaster like that, you don't do a 1031, you do what's called a 1033. It's very similar. It's called an involuntary conversion, meaning that it was burned down. I didn't want to sell it, it was involuntary. But it's very similar to a 1031.
What are the key differences?
You have longer.
Longer
You don't.
time?
It's not 45 and 180 days. You have anywhere from 2 to 4 years to replace your investment.
Nice.
Is that for the identification or the closing?
There really is no identification process in a 1033. It's just replace the asset, either through an acquisition or through rebuild. But yeah, it happened here in town, not through fire. Again, I don't know how long everybody's been here, but there was a US 95 widening at Jones, oh gosh, 10, 15 years ago. there were everybody know US 95 and Jones, kind of
Yeah.
work with me?
Mhm.
Okay. If we kind of look at the northwest, if we're at that intersection, northwest of that intersection, there were homes on the northwest side of Jones and 95 that the state took out because they needed to expand the freeway, and they were right next to it. So they came in basically by eminent domain, took out those houses, knocked them down, were able to expand the freeway. They got the same benefit. They got this 1030, they were able to do a 1033 exchange if it was a rental house, an investment, because then they were able to go buy a new property. But it happens here too. Happened in, in the 90s, back on Fremont Street. I don't know if you all know, Fremont Street didn't used to be covered. It used to be a street. And then when they covered it, they came in, government came in, eminent domain, a lot of those businesses on Fremont Street, able to do these 1033 exchanges. So it doesn't come up that often, but it comes up for disasters, it comes up for eminent domain, Hurricane Katrina in 2005, or 6, excuse me. I had offices, I was with a different company in 2018, and I used to run our Southwest region, and I had an office in Texas, and Hurricane Harvey blew through September 2018. It leveled Houston area, it was terrible. My office in Kingwood, Texas was 6 feet underwater after the hurricane for 30 days, and the water didn't recede for like 90 days. That's when we had no water in our office. And that was just us. There were other people that were totally affected. There were extensions for them. They don't have to do 1031 to get this 1033. So things like this happen often. The wildfires, sometimes it happens with the storms in Florida last year. Remember there were 2 hurricanes that hit Florida like within 2 weeks? Milton was one of them, and I can't remember the second. But taxpayers there got extensions and didn't have to do 1031 because of these hurricanes that could do 1033. So it's all these involuntary things that happen, natural disasters and things like that. So I don't say it never happens, but it happens actually more often than I really want to talk about. So that was the third tax, recaptured depreciation, deferred by 1031. Last tax you don't pay when you do a 1031 is 3.8% net investment income tax. This was a tax passed in 2013, part of the Affordable Care Act. When it came out in 2013, the government said, we gotta pay for this someplace. So we're gonna create a new tax. It only affects high earners, not my words. In the bill, it says it affects high earners. Who are high earners have to pay this? Individuals with an adjusted gross income over 200,000 in a year, or married couples that make an AGI over 250. So if I sell a property this year and I don't do a 1031,
Hasn't changed with inflation?
this one doesn't index, unfortunately. And I don't know why, it makes no sense. That's been a number since it came out. So I sell a property this year, I make 100,000 profit. I gotta pay, and I don't do exchange. I gotta pay federal capital gain, state capital gain, if I live in a state with the state capital gain. I gotta pay my recapture. But let's say I'm married and we make 300,000 this year. So we're over the limit. I gotta pay an extra 3.8% of my profit to the federal government to pay for the Affordable Care Act. Unless I do a 1031. Then I don't pay this tax as well. So there are 4 taxes you don't pay when you do 1031. Federal capital gain, state capital gain, recapture depreciation, 3.8% net investment income tax. When you add it all up, in Nevada resident selling Nevada property, because then we don't have Nevada state tax. This is a generalization, I'm just taking a guess. Taxpayers in Nevada, we average anywhere 20 to 25%. So if I sell a property here and I make 100,000 profit, I'm probably gonna owe 20 to 25,000 in taxes, unless I do an exchange and then I pay nothing. If I live in California, or I'm selling California property, heck, it could be 35%. So that's what you're looking at when you do 1031, how much someone's gonna pay. But that's why 1031's there. It gives you the benefit, gives you the option, I should say, defer all of it. Keep all that money and you're able to use it all to buy your next property.
I have one more question about the 1033.
Yeah.
Does it have to be completely, like, destroyed, like, the property, does it have to be completely gone, or can it be partial?
I can't really speak, is it, partial, yeah, I don't know, cause I don't do 1033s. I would say it probably doesn't have to be completely destroyed, but then you better just take all that money and just reinvest it there. You know, if you had a property that was, and I'm taking a guess here, okay? If I had a property that was half burned by fire, through the fire, I better take that payoff and fix it up. Cause then I won't pay my tax, I'll be back to where I started and I'm fine. If you take the money, some of that money is gonna be taxable. So that's where the person's really gotta talk with their tax person and say, all right, what's our best plan? What do we do with that money?
Are there companies that deal with 1033?
No, 1031 companies don't touch them because you don't have to hire a qualified intermediary for a 1033. That's where you go through your tax professional. They're gonna have to look it up and do the research for you.
But there's no person that goes through
Nope.
money like
The other thing in a 1033 is we don't have to hold your money. Like in a 1031, I said we have to have that money from the sale. 1033, you're allowed to touch it.
So it's like a regular transaction?
Kind of, yeah, you just have to track it. So like, I do have a client that just recently did a 1033. What did he do? He got the money, he opened up a separate account at the bank and just put the money there, so he could show the money coming in, and then he bought new property, and now he has records of the money going out to a title company to buy new property. So he's got all the records of it not commingling it with his money, he never used it to go on a vacation, he took out $1,000 to pay for a hotel, nothing like that. He's got all the tracking. So that's where you really work with your tax professional. How do you want us to do this? What's the best way to structure it? All right, I'm done. Any thoughts or other questions? I appreciate the questions, guys, because I don't like talking for an hour when I'm by myself. But you have my QR code. That's all my contact info. Like I said, I'm not that far away. I'm at Town Center and Summerlin Parkway. So that's where me and my team are. I've got team nationally as well. So, you know, if you call into the office, if I'm not there, one of my team members answers. You might actually get somebody that's not here, but you might get somebody here. I answer the phone when I'm there. We're all around. Anybody can answer any questions for you. Yeah, whatever I can do to help. That's what we're here for. 1031's really not that hard. It's a great trend. I love 1031s. Like I said, I've been doing this almost 25 years, over 20,000 exchanges. I love it because I get to help people not pay tax. So people normally like me. They like me calling and like talking to me because what am I doing? I'm saving them money, so I like talking to them. Yeah.
Do you personally have any 1031 properties?
Have I done 1031 exchanges? Yes.
For yourself?
Yes.
Yeah? Okay.
I love 1031. Well, of course I do. Yeah. Thing is, I don't like being a landlord.
Yeah.
So I own dirt.
Oh, okay.
Me and a couple of my buddies, we own. I'm not a big investor. I don't make enough, unfortunately. But we own a little bit here, a little bit there. And yeah, you know, we've had some good investments, and in the recession, we had some bad investments, and you know, but it is what it is. But yeah, I don't like that call at 2 a.m. You know, oh, the plumbing's backed up. Send somebody out here. The AC doesn't work. I owned one rental property years ago, and that was the last one I'll ever own because yeah, I managed it also, and that was just a bad move. So I sold it, got out of it, made a couple bucks, didn't exchange, and went and bought some dirt. So yeah.
Where at?
We have two pieces of property here in town, and I've got a piece of property down in Arizona.
Okay.
It's what you buy.
What part of Arizona?
Maricopa County.
Oh, okay.
Because, you know, you buy on spec. Dirt is just buying on spec. You buy a property and you think someone might expand there, you think a builder might go there, and then so you can hopefully get a profit on it some point down the road. But like I said, I don't get a call. No one calls me 2 a.m. because the AC isn't working. So. Any other thoughts or questions about the process, please? All right, well, I know you guys signed in. So I've got the sign in here, and like I said, what I'll do, thank you. There was like I said, two ways. You could have either done the QR code, and then that'll pop up in my email later, and I will email this to you. Or, like I said, if you signed in, I'll just shoot you an email, with all the information. I'll send you, two things. I'll send you a copy of the presentation, and I'll also send you a digital copy of this flyer with the map on the back. So I really like that map. I think it can be, she's got some? Oh, sign it. Sure.
So if you get
The one thing about that, I didn't say it, about the map, why do I think that's valuable? If you're trying to market to investors, that's where you want to market. Maybe you don't market to investors right now. Maybe you are just working with people selling their primary residence. That's where I would market to. I would market, oh, the map is up there. I would market in that Spring Valley area, where over 50% of the properties are rentals. You know, work with your title company. I know you guys have in-house title. If you don't work with them, you can. We've got a title company. I'm not part of the title company. Security First Exchange is the company I run, but we're part of Security First Title. And like I said, we have offices right here. A good title rep can help you with a farm for investors. And then you can reach out to those investors directly. And because they're selling. And normally, NAR did a study. The average homeowner is living in their house right now 8.82 years. So call it 9 years. So if you sell to Bob and Mary Smith, bought their house, you're probably, on average, you're not going to deal with them again for another 9 years. Okay, that's fine. Keep them in your pocket and hopefully they'll reach back out to you. Investors are selling roughly every 4 years. So they sell more often. They have more properties. Because normally if you want one rental, you might own 2 or 3. They sell more often because they want to turn. After they own that property for 3 or 4 years, now they're starting to get, maybe they're starting to get, I hate when it does it. After you've owned the property for 3 or 4 years, most of my investors want to change because now they're starting to get problems. You know, okay, maybe a plumbing issue or this issue or that issue. Time to sell. Let's sell it. Let's go buy a new property. They do it more often. So working with investors, you're going to get more transactions. And if they're doing 1031s, you're going to get a transaction, their sale and their purchase. So you're going to get 2 transactions at minimum within that 180-day window we were talking about. Whereas if you're just dealing with people on their primary, all right, they buy the house and now you're not going to talk to them again for another 7, 8, 9 years. So investors are a great way to go. I'm not saying ignore anybody. I'm saying work with primary work with primary homeowners and work with investors as well. But work with your title rep to farm for these investors. And the other thing you get out of that is you learn 2 things. If you get a farm for investors, you find out who owns these rental houses in this area that you're looking at. Now, if Bob and Mary Smith own this rental house, what else do you know about that house? A tenant's living in there. So now you can market to the tenant to help them buy a house, and you can market to the investor to do a 1031 to sell and go buy something else. So you've got 2 pieces of information just by learning that 1000 Main Street's a rental. So work with your title people. Like I said, if you don't have a title rep to work with and you need a referral, shoot me an email. I can refer you to one of our people at Security First, and they can sit down with you and help you farm and get you that information. So, like I said, if you have a title person, great. Work with them. Tell them this is what I want to do. I want to farm this area, and I want to start getting information on investors so I can start marketing for them. So, I'm sure Damien could help with that too. I mean, he understands the whole process. No, he wasn't here. I just threw his name out. You're stuck. Now you got to go bug him. But yeah, just some thoughts. So, all right, guys. Well, yeah. Anything else? All right. Well, I appreciate your time today. Anything comes up, like I said, you got my card, you got my email. Shoot me an email. Let me know what you need. So, thanks everybody.
Thank you for your time.
Yeah, of course. Oh yeah, my pleasure.